Hello, friends. Welcome to episode 39 of Long Shots, our weekly podcast. So, this is Nikhil Arora. I have with me Sharad Tupran, the usual suspect. And today's guest is Mr. Mayank. Hi, Mayank. How's it going?
Hi guys, I'm doing well. How are you guys doing?
Yeah, all well, all well. So, Mayank is the founder of India Lens, which, as per Mayank's own LinkedIn description, is a credit underwriting and analytics platform. Now, as we all know, once a company starts, after 3 or 4 years, the descriptions keep on changing. But is it still pretty much spot on?
Again, I think given our sort of backgrounds, right? So me and my co-founder both used to work for a large bank in the UK. And I think given our backgrounds, I think we continue to focus on the thesis that analytics in underwriting sort of solves a large problem for India. So we continue to work on that. I think the business model has evolved a lot over the last 4 years, but we still continue to find ourselves in a place where I think we're still trying to solve the problem of we feel that there are a lot of people who are creditworthy in the country that don't have access to credit right now. And that's where I think we play a part as a platform. We're actually enabling a large number of mid-size NBFCs. I think that's maybe our sweet spot. We're enabling a lot of them to actually lend to some of these segments where nobody's actually ventured before.
Interesting. So let's, for the benefit of our readers, let's sort of take a step back and start from India Lens. That's the name of the company that you run and you founded. How many years back was it? And
it's going to be about 5 years now.
Oh wow. Okay, it's been 5 years. So I know you talked about sort of lending, like, you know, for a person who doesn't really understand, let's call it the nuances of lending and underwriting and credit scores. Like, talk us through a very typical one line or a brief overview of what you do in terms of origination. Is it underwriting, so that people can understand, and then we can sort of walk through your journey, because it seems very exciting and it's a very hot space right now.
Yes, I think it's
The
exciting.
heat of the space is because of all sorts of reasons.
Yeah.
I think we can touch that.
I think there's a lot going on in this space.
Yeah.
But I think going back, right, again, given our backgrounds in lending, I think the idea has always been that we sort of look at retail lending, consumer lending. And so I think when you look at consumer lending, we're mostly talking unsecured credit, we're talking personal loans and credit cards. And so given our experience there, I think what we realized when we first moved back was that there was a large gap between the demand and the supply.
Mm-hmm.
And when we sort of started to investigate more, we realized that I think there wasn't a shortage of supply. So our initial thesis when we moved back, right, given what we had seen in the UK market, P2P lending, peer-to-peer lending had actually become very big.
Right.
And at that point, we had come back with the idea that most likely that's the model that we were going in with.
Sure.
But then we quickly started realizing, I think it was about 4 months when we started researching into this space, that there was no shortage of supply.
Yeah.
There were a lot of banks sitting on a lot of capital waiting to deploy but didn't have the ability to deploy.
Okay.
And that's when we started scratching our heads and trying to figure out where was the gap. I think that over the next 2 to 3 months, I think we figured out, I think the gap primarily was the cost of origination and the cost that the risk brings to the portfolios, right?
Yeah.
So I think to simplify some of this, when you look at a bank's operations, there are 2 sets of operations that they're doing, right? One is sales, which is the sourcing, acquiring the customer, which means that you have to actually go out, reach out to the customer, and there is a cost to that, right? And so when you look at it, a large bank, let's say a private sector bank, employs anywhere between 10 to 20,000 people on their sales force, which are people actually speaking to customers, trying to make them understand the loan product and trying to make them close the loan.
Yeah.
Right? And so disburse the loan finally. That, along with the fact that I think most of the deciding of who to give a loan to, which is what we're calling underwriting, right?
Yeah.
We're deciding of who to give a loan to. That largely is still manual in this country. And I mean, at least when we first moved in, was very manual. And so when you're looking at that and you're talking about servicing a country of about 100 crore people, you have to understand that the number of very, very skilled people that you need to be able to decide some of these things makes it a very expensive proposition for most banks to actually originate loans.
Yeah.
Now, if you do simple math, you sort of come back to this answer that for most banks, it does not make sense to do a loan below a certain amount because of just purely the cost of originating or acquiring a particular customer.
The economics don't work out.
The economics don't work. And when you look at that and put it against the fact that most of India is looking to borrow loans less than 1 lakh rupees.
Yeah.
But most banks are only able to economically, or it's viable for most banks to lend only about, let's say, 2.5-3 lakh rupees. And that was the biggest gap.
Yeah.
Right? And so that's the gap that we started to attack.
So, I think during the conversation you referred to coming back. So, just for the benefit of listeners, you worked in Capital One for
Yes.
I think 5-6 years.
I was there for 6
So you were
years.
in UK.
Yes.
You obviously were in the middle of looking at credit as a space.
Right.
So you moved back there. You probably looked at a lot of peer-to-peer, maybe not in your job as Capital One, but as a potential growth area. I guess you
Yes.
looked at China. You thought that something can be replicated here. You move back. You kind of then realize that no, okay, there is a lot of structural gaps already in the existing market. So we don't have to like reinvent the wheel. Let's look at the value chain. Let's refine it and get in. But I'm sure this was not a 2-day, 3-day decision. You must have gone through a lot of, I would say soul searching, introspection, talking to a lot of people. What was the like a lot of the I think the big perception of startup founders is that you are actually, you have a eureka moment where you think, oh my God, but it's usually not the case, right? Typically it's a result of a lot of iterations, a lot of conversations,
Completely.
right? So just walk us through your journey. How did you kind of, from something so like Chinese or Western, you kind of gradually funneled it down to a very kind of Indian problem, right? So how did you approach it? Like, who did you talk to?
So again, I think I'd say we were blessed to have actually reached out to the right people and spoken to the right people at the right time.
Okay.
Given that we moved back and we had this idea, right? We were actually I think we decided that we were going to do peer-to-peer lending. We were sure about it. Not having understood the real problem in the market, right? We had decided. So we started working on the business model. And in trying to work on that, we actually met a lot of people, right? Because there were a lot of regulatory challenges around that model. Right. One, a lot of legal things that we had to understand, and obviously we had to actually understand the lending process itself, right? From how do you figure out, how do you source customers, to how do you actually...
This is the time when peer-to-peer was not, I guess, in the mainstream regulatory regime, right?
Yes, this is, I'm talking 2014.
Yeah.
This is like, I moved back around September 2014. And so this is when I think people were still not very unsure of what the regulator stance was going to be.
Right.
On
so technically nobody was stopping you from like starting a fintech platform doing P2P tomorrow.
Yes,
nobody
would have.
So it was actually, there was no regulatory quote unquote constraint.
There was no constraint. There was no constraint. So there were, again, I think, so there are certain things, right? There are like some money lending. There's an act called Money Lending Act.
Yeah.
And then there are other regulations that talk about how sort of money flows. And so one way of doing it is actually setting up an NBFC. Right, and then that would have been the traditional way of doing it anyways.
Yeah.
At that point. And anyways, I think setting up an NBFC at that point wasn't as easy as it is these days, right? I mean, a lot of people are setting up NBFCs.
Sure.
Back then, it wasn't the first thought that someone would come up with that, let's set up an NBFC.
Right.
And I think there were a lot of other challenges with setting up NBFCs back then. So our thought was that, we were trying to figure out how the money doesn't flow through us. And in that process, because if the money starts to flow through us, then you sort of come in the regulatory regime,
right?
And then you have to figure it out, right?
Yeah.
And there was no
so you were kind of
regulation
anticipating that maybe it's not under the regime right now, but it's anyways going to come in.
Yes.
So might as well steer away from it.
Exactly.
And stay safe.
I think we were well advised to steer away from it.
Okay.
Right. I think we spoke to a lot of people.
Right.
I think finally it came down to the complications of actually executing it were so insane.
Yeah.
And the biggest issue was Aam Aadmi's money. Right. I think at the end of the day,
yes,
it's a risk,
and it becomes a huge risk issue.
Yeah.
Right.
And so at that point, I think we met a lot of people. We met some regulators as well,
right,
to try and understand. We met a lot of lawyers in the financial services space, and then we actually met our advisor, who currently continues to advise us. He was the founding member of a very large bank in this country, and so he was the one who actually showed us the real way, right? And this is maybe around December 2014.
Right.
We'd already spent 4 to 5 months working on the P2P lending model when he actually told us that, and I think that was maybe the first eureka moment, which wasn't really eureka, is that actually there is no supply shortage in this country. Right? He was coming from a banker's perspective.
Right.
And he clearly had that view that, there is a lot of capital that all of these banks and NBFCs are sitting on, but are not able to deploy. And that's when we actually realized that what strength that we bring to the table was actually the gap in the market, right? And I think the thought was very simple, that if you're able to use tech and analytics to bring down the cost of origination and to actually manage risk, then for most banks and NBFCs, giving out loans less than maybe even 1 lakh rupees, maybe even less than 50,000 rupees becomes feasible.
Yeah.
Right. And that's the play that we actually started to enter into at that point. we realized very quickly that if you're able to bring down all of the costs, the economics suddenly start to make sense.
So like you have, I guess you have a panel of partner banks
Yes.
and NBFCs, right? So the idea here is that they obviously have some sort of a set cost of funding,
Correct.
right, which they are ready to deploy it at.
Correct.
How much do they, like, to what aspect of the entire origination process do they depend on you from the perspective of pricing?
So again, it's in most cases it's a joint process, and I'm talking about today.
Yeah,
right?
okay.
This is like it has evolved over the number of years. But when we're talking about today, I think most of these are joint decisions, right? So it is like there are principal agent relationships where we're actually working as partners, technology partners, if you can call it that.
Right.
And so jointly we are deciding on what actually works, right? So this is technically, I mean, I'd probably compare it to my Capital One days when we're coming up with, let's say, a new program where we're launching a new product. We take the same sort of steps to launch a new program with this bank. The large difference actually, it's not the only, is the largest difference is that actually the bank's ability to, or their agility to do some of these things as fast as we are able to do, actually makes us their preferred partner. Right? The fact that they're not able to do it fast enough, there's a lot of, I guess, one regulatory, I wouldn't call it burden, but there's a lot of regulatory, regulation related things that they have to actually worry about.
Right.
There's a lot of tech stuff that they have to worry about.
Right.
A lot of their tech is legacy. Right?
Right.
And for them to be able to work on some of that stuff is going to be next to impossible. But they obviously want to work in this space, right?
Right.
And so we just go in as a partner.
But like, I mean, like, sorry, there are like, there are two areas, right? One is data, one is efficiency. So if suppose you are trying to originate a customer who is, let's say, not on the business as usual radar of the bank or the NBFC. I mean, by the nature that the customer doesn't have that much legacy format data.
Sure.
Obviously, someone like you comes in and you would tap or track alternate data sets which the bank or NBFC doesn't look at, and you are able to advise them in a combined, holistic manner.
Correct.
So that is looking at new borrowers who are not really on the radar.
Correct.
But there is an existing efficiency play with borrowers which are already on the radar.
Correct.
Right? So how would you, like, you are positioned more on the data side, on the efficiency side? Is it a 50-50 thing?
It's our efficiency play is our foot in the door.
Right.
And then that sort of evolves over a period of time into the data play. For most people, their comfort, and when we're talking large banks and NBFCs, their comfort in opening up new segments is not very high. And so the foot in the door in most cases is that we go in and we actually talk to them about, these are the things that we can do for you. It's mostly an efficiency play, if we can call it that, right? These are all customers who, let's say, have bureau profiles to start things off.
Sure.
Let us drive down costs. Let us improve risk predictions in these segments. And let us start driving up risk-adjusted margins, right? Which is what the NBFC actually thinks about.
Right.
And so let us start driving up risk-adjusted margins and let's start scaling up. And so the thing that we found, I think, is that most of our play, or the people that find real value in us, are the mid-size NBFCs. Right? And this actually has a lot to do with, I think, what the country has gone through in terms of the crises that we're talking about, the NBFC crisis in general, whatever's happened in the last 3-4 years. I think a lot of the lenders were relying heavily on infrastructure lending, or relying heavily on large corporate lending. And so they were players who would typically deal with, let's say, 1,000 crore type ticket sizes. And now that market has completely gone away, and these guys have very, very large balance sheets. They're actually looking at retail lending as not only a very diversified way of lending, but also a very high margin way of lending.
Yeah, and there's greater asset liability matching as well,
Yes.
right? I guess. So just to understand better, a person who's borrowing using your platform, is he interfacing with you only, or is he interfacing with your partner, i.e. NBFC/bank?
With us only.
With us. So does the collections risk or the collections operational collection?
Okay, so there are two parts.
Does that come to you? Yeah.
Actually, sorry, I think I take this thing back, because up until final dispersal, the customer is only interfacing with us.
Okay.
But post that, the collections is handled by the NBFC.
Yes.
Right? So with the lender. So these lenders already have large collection setups.
Yeah. So now I understand exactly how you fit into this space. Like, it's streamlining the entire supply chain, right?
Yes.
You guys slot in perfectly there. So that's very interesting. And in terms of the typical profile, let's say, of a borrower who's engaging with your platform, are you seeing like consistency amongst that as well in terms of use of funds? Let's say, I mean, you probably don't know, but use of funds or
Actually,
time?
it cuts across.
Cuts
It
across?
cuts across. I mean, we see maybe between 10 to 15 different types of use cases. The larger ticket use cases tend to be more medical emergencies
Got it.
or holiday related things.
Yeah.
And the smaller ticket things sometimes tend to be more, I sort of swipe my credit card and I'm paying very, very high interest rates on it and I'm consolidating that debt.
Yeah.
Right. So it varies a lot, but it cuts across. I mean, there is not one category that's very big, although I'd still say just in terms of pure amount, it's medical expenses, weddings are very big reasons.
But do you see like I keep on, reading about, if you look at millennials or generation, I don't know, Z, X, Delta, whichever. So, I mean, they're supposed to have a slightly different consumption pattern.
That's
so as
for
to
sure.
say.
Gym
That's for
membership,
sure.
Right,
financing.
like borrowing to even fly for the weekend to Singapore.
That's for
I mean,
sure.
it's very different from the generation.
I mean, I
before
think
us.
it depends, right? See, I don't have data about our generation specifically to actually go and compare.
Yeah.
But we're seeing a lot of people apply for travel loans, travel-related loans.
No wonder I was going through your blog and there was some post on travels and holidays. Yeah.
It is a big category for us, especially right before summer. A lot of people are actually, I think this is the Instagram generation, right?
But the savings rate in India is also going down for the last 10 years. So, I mean, who should I blame you?
No, please don't blame me. See, we're trying to enable the ecosystem, right? At the end of the day, there is already a demand.
Yeah.
I think when you look at
No, we were just having a very structured conversation. So I thought, let me mix it up a bit.
spanner in the works.
Yeah.
And this question, like you can feel free to not answer it, but two questions, I guess. One is when you cited medical emergency or travel, what's the end-to-end time? Let's say today I got to get on your platform and let's say there's an India-England World Cup game, let's say, and I'm really interested. Do you think it's a Friday evening? It's a Friday evening, let's say someone decides to go, so there's got a...
You are high risk. I think you'll get rejected.
There you go.
Who decides on a Friday night that they're going to go to England on a Sunday morning? But jokes aside.
But I'm comparing that to medical emergency. That will happen with a 48-hour window, right?
So again, most of the process, that's actually depend on the customer. See, there are certain documents that we require, right? I mean, as per regulation, we're required to collect KYC documents and a bunch of other documents. I think that takes most of the time.
Sure.
The fastest that we can do a loan is maybe 10 minutes.
Okay.
But you must have seen a dramatic, I'm hoping, I keep on reading about, ease of doing business, rankings improving and things getting more digitized. But when it comes to like these things like onboarding customers, documentation, e-signatures, how much do you think we have progressed in that department?
I think we were progressing and then obviously the Aadhaar ruling came in.
Sure.
Right? Mm-hmm. And so that sort of set everyone back. I think the biggest reason for that, the large setback, was that banks had invested a lot and they had invested a lot of time, money and in building the infrastructure around Aadhaar. Right? And so then when all of that went away, we actually sort of moved back maybe 12
but has
18
it
months.
Completely gone away, you think? I mean, because after the ruling, there are always these, disclaimer kind of so ordinances or orders coming in, right? Which were kind of the usual.
Yes.
Like there's a blunt force trauma and then you try to manage it.
But it's not come back. Okay. So I think the main thing that it was going to be used for e-signs, the e-KYCs, that's all gone.
Okay.
Right. So there's obviously a lot of work happening outside of that.
Right.
In trying to do some of those things without using the Aadhaar ecosystem. And so I think the regulators reacted very quickly and actually come out with very interesting things in helping us.
Right.
But it sort of set us back I think we were expecting for all of this to go live maybe 12 months back, for everything to be digitized by now.
Right.
But it's not happened. But in another 6 months, I think we're hoping that it'll all actually come back.
Okay.
Without Aadhaar, right? So the Aadhaar ecosystem is not used at all, but there are other ways of us actually doing KYC. I think SEBI already has something around video KYC. Right. So I think RBI is going around with that idea. I think that sounds like a very interesting idea. I think when those things start to happen, I think we'll still solve the same problem in a different way.
A bit of a kind of a related but segue point as well. Like I guess India Lens is like the founding member in the Digital Lenders Association, right?
So we are amongst the 5-6 one that founded Digital Lending Association.
So like in terms of like stakeholder engagement, I guess this must be one of the hot areas, right?
For sure.
And I mean, in terms of the like how I know, I mean, this you can choose to answer or not to answer this, But in terms of like regulatory interface with the industry body, what's your overall take on it in terms of do you feel that the comments or feedback given in is well received?
Very much, actually. Very much.
Okay.
I think this that we've realized, actually, independent of DLAI as well.
Right.
There is a lot of this stuff being driven by Niti Aayog.
Yeah.
And so we've actually participated in a lot of events where those guys have come out and asked all of us, where is it that we need help? Right? I think the thesis that the government has, and this is one of the sessions that we attended, was that I think for India to go from a 5 trillion to a 10 trillion economy, fintech is going to be the way that sort of paves the way for that. Right? I think that's the thesis that this government has. So I think there's a lot of focus.
But that feedback actually goes all the
way. It does, right? And what we're talking about, some of the timelines in how some of these things have been experimented with and how soon these guys have come back with solutions, how it's been implemented. I mean, you take examples of how UPI works seamlessly, right? I think it's become, for most parts, the primary way of people making online payments.
Yeah, I use that a lot.
Yeah, right?
I personally use that a lot, yeah.
The rates have gone up, and I think all of that has been enabled because this government strongly feels that these are the pipelines that will help us become the $10 trillion economy that I think we want to become in 10, 15 years from now. I think that's the thesis. I think we've had great support.
Ooh, so my cynicism has been unfounded, it seems. Anyways, I mean, in terms of, like we are in kind of budget season. Lending is, obviously we kind of touched upon it briefly. Consumption data is pretty, I think everyone is commenting a lot on it. I don't know how structured it is, but everybody's commenting on it. And, anything from housing to auto spends is pretty much linked to credit. I think a lot of it comes from NBFCs. Most of them are your clients or your partners. What's your take overall on the, NBFC credit space in India? Is this like I mean, I know that in terms of like commentary, it's the end of the world every time, but it's obviously not.
Yes.
What's your take? How?
So I'm hoping it's not the end of the world. I think what NBFCs have done for the ecosystem in the last 10-15 years, without them, I think all of this wouldn't be here, right? When we talk about some of these large lenders like Bajaj, what they've been able to achieve, and even
do you feel that post, like when we can actually kind of have a historical cycle, right? Sure. Like you had NPAs were going up. Obviously, that amount of funding kind of got redeployed a lot through NBFCs.
Right.
So, do you think there was a lot of risky lending going on at that time at a general level?
I think to term something risky, unfortunately, I think the challenges are more ALM, right?
Okay.
I mean, right now the challenges that we are talking about are more ALM.
Yeah.
I think when you're talking about an NBFC, inherently you're talking about lending in segments that a bank wouldn't be lending in, right?
But in terms of like internal risk management frameworks,
that's how they operate, right? Yeah. That their cost of borrowing is higher, but they lend out to people who are maybe slightly higher risk. Yeah. And so fundamentally, I don't see an issue with the NBFC space, right? I don't think there is this issue. There might have been a few, I guess it happens in most markets, right? I think when money is cheap in the short term, I think people tend to sort of borrow it, and then I think that discipline now, I think there is regulation that has come out very recently. That is, I asked them to actually have like proper ALM.
But even those are kind of pretty linked to what kind of risk management frameworks you have internally, right? Like I mean, you worked in a financial institution. Both of us have worked in different financial institutions. At the end of the day, I mean, there are teams of people who make sure that those processes are followed like clockwork, right? And even then, things can go wrong because it's inherently that's the nature of the business. But do you think there was like some sort of something amiss when it comes to operational and strategic, checklists in a lot of the institutions?
It's possible. I mean, it's possible.
The reason why I'm saying that is that as an outsider, like I mean, we obviously like to follow the news and the data, but we never get that kind of a ops heavy view. Like obviously when the ILNFS thing kind of imploded, immediately after that, I mean, a lot of mutual funds just kind of froze out, right?
Correct.
Now, call it panic, call it something structural, you never know.
Yes.
It's pretty difficult to kind of draw that line.
Agreed.
But like within the industry, is there some sort of a realization that no, this was actually something structural and not just panic?
But it is something structural more on the infrastructure side, right? Not more on the NBFC side. If you think about it, that infrastructure sector in itself has its issues. I think the fact that, when you look at lending, right, you start to expect money back as soon as possible, right? I mean, there's like very little moratorium in most of these lending products. But when you're looking at these infrastructure projects that are getting delayed, fundamentally the issue starts there.
Yeah.
But that's for something like ILNFS.
Yes.
But like the wider impact has gone to other NBFCs as well, right? Who are into consumer lending, who are into other, I mean, in terms of like a kind of liquidity crunch or so as to say. Now, is that overstated?
I think my feeling is that I think all the ones that have, like, especially the consumer lending ones, don't seem to have any liquidity issues, right? Most of the liquidity issues that are there, I think, are on the infrastructure side. NBFCs that are largely lending in those segments maybe have some of those. Not all of them have structural issues. I am certain of that. Not all of them have structural issues. I think there are issues maybe in the segment that they've been lending in.
Right.
There might be some issues internally as well, but I don't think they're as big as I think everyone makes to or seems to believe.
Right.
The fact that I think this happened about 6-8 months back as well,
Sure.
right? People quickly understood that this was not a fundamental issue
Right.
in some of the larger NBFCs, and those guys got capital again. I think this is more a sentiment thing.
Yeah,
I think I think the budget will have a lot to do with moving the sentiment.
But like in terms of like consumer slowdown, so your thesis is maybe that look, supply side was slowing down already. It was only about time that demand side also catches up. Would you say that?
I don't know. I think, see, if you were to, I have not felt it, right, personally. I don't think the consumer demand side of it seems to have gone down.
Okay.
If anything, it seems to be going up, right? From where we see it, the consumer demand story actually seems to be going up. There might be minor blips. See, I think the challenge is that, right, in a panicky environment, people tend to lend less.
Right.
It happens across, right? It's not restricted to India. You look at
it's like a chicken and egg thing, right?
Yeah,
right.
It's like people are waiting and watching, right? You're more seeing the waiting and watching play than actual fundamental issues in that. I think most people are more keen on lending on the consumer durable space that we're talking about, right? A lot of people are buying these phones. There are a lot of NBFCs lending in that. From where we see it, we've not seen a slowdown in that space at all. Especially because there are a lot of fintech guys. I mean, some of our competitors, some of our close friends at DLAI, I think those guys have focused on this sector a lot and actually are scaling up rapidly.
Right.
So when you look at that, I'm not seeing a consumer story in terms of demand having slowed down. I'm not seeing that.
Right.
I think to us, actually, it feels like more a blip right now.
Right.
The only thing is that to come out of this, we might need to see some action from the government or the regulator. We might need to see that.
Right.
But otherwise, people will continue to play the wait and watch game.
Any expectation in terms of the budget, in terms of what you would like to see? Let's say.
See, I think my belief, right, and this is what I was getting to earlier also. Some of these NBFCs that we're talking about are actually, and I think there is a term for it, right, systemically important in some cases, right? Sure. They have actually solved a real problem. I mean, they might have risk issues that might not be due to their own structural problem, that might be due to other issues, but they have actually solved a real problem. And I think that we need to figure out, as I think the regulator and in the budget as well, need to figure out how to solve the problem for these guys. Because they're solving a real problem. Banks are actually, because of the regulation, because of the issues that have happened in the past, are not lending as much.
Right.
And that's the truth. They're not lending as much.
Right.
And so someone needs to fill that gap, right?
Yeah.
Because otherwise, then you will see the consumer slowdown story. Maybe the consumer slowdown story is that the fact that banks are not lending as much as they used to. Yeah, especially public sector banks.
You're seeing that in car sales for sure. 12 consecutive months of declining car sales. June again was low, and it is because banks have sort of lost their appetite in underwriting loans. I guess. In terms of typical consumer. What sort of interest rates do they carry in terms of, and second, I mean, obviously it's tied to the person. What kind of analytical framework do you have in terms of deciding the credit worthiness? Is it typically what happens with Chrysler score? Is it exactly that, or are there other data points that you guys proprietely capture, or is there an in-house method, or is it?
I think the origin behind this question is we keep on reading. What was that? I think. It was M-Pesa or something in Africa. Like you look at prepaid balances. Someone looks at which kind of phone do you have.
Yeah. See, there are a lot of interesting ways to look at. There are a lot of interesting ways to look at credit risk. Honestly, right? I think the first, if you try to break it down, right? When you look at credit risk, you look at intent, ability, and then figuring out fraud.
Yeah.
I mean, across these three pillars, you need to figure out if this person is credit worthy or not, right? And so if you look at it, the biggest role that the bureau plays is mostly on intent. This guy's borrowed before, he's paid back, he's most likely to pay back. right? Now you can quantify it, right? You can come up with a score based on different parameters, and you can differentiate between two people. Layered on top is the ability to pay back, which is maybe your bank statements, your salary slips, how much you earn, what is your rent, and trying to understand those things.
Yeah.
Right. And then there's obviously an element of, are you the person you are, who you claim to be, right? A lot of the KYC and all of those things actually take care of this largely.
Yeah.
Right? Because you go the extra mile in trying to figure out if the guy is here, living here, this is his KYC is proof of address, proof of identity. That part of it is mostly taken care of. Although there sometimes is still some amount of fraud, but mostly not as much as what you see in the West. Now, there are many ways, right? In a country, let's say, I don't know, some part of Africa, when there's no bureau, I could use the fact that, I don't know, you use a particular phone in deciding the difference between the two of you. But the fact that you already have a bureau, let's say you guys have been using like credit card for a number of years, it actually gives you significant information about you, and I don't need any more information.
Yeah.
Right? And so, to the fact that a lot of these countries are using these interesting data points, they might obviously be useful. But when you look at a country with an evolved bureau, very evolved, right? And we're looking at, I think 2005, the bureau was set up. There's now about 14 years of data about a lot of the customers. There are about 380 million people on the bureau.
Right.
We're talking a big coverage and what we term thick bureau files, right? And people have actually been credit card or a particular loan product users for multiple years. That gives you so much information about the person that sometimes some of this information becomes not as relevant, right? That doesn't mean that there isn't more relevant information out there, and that's the business that we're in, right? So our job is actually, so what we continue to do is build models by using lots of interesting data points, right? Things like the phone you use. It might come in useful, it might not come in useful, right? And it only depends on how strong my existing model is. So we use things that you tell us as like a customer coming to us. They give us application form data. They tell us who they are, where they live, where they work, what their salary is. They answer a few questions. That tells us a lot.
Sure, yeah.
And that layered on top of the bureau, along with banking information, right, which we sort of collect bank statements and get that from there. This combined actually gives us a lot of the value. Right, and then I think layered on top, there might be a couple of variables here and there that we continue to sort of play around with in trying to understand that, oh, this person's behavior is such and therefore he might be this risk. Right. I think the idea in lending, the idea is always that the models keep evolving.
Yeah.
So nothing is static today. There is a large number of data points that we're using. The model is constantly evolving. I wouldn't be able to tell you exactly the variables that are there in the
But
model.
like there are a lot of I think buzzwords in the industry, right? In terms of look at social media, we look at this, we look at that. I mean, if there is obviously a scenario where the person is covered extensively by regular metrics, say from the bureau, right? And in case that's not the case, there are these alternate data forms which kind of fills as a gap. But let's say you have two models. The same person is covered extensively by the traditional data points, and the same person we only look at it from an alternate data perspective. Do you really see one as a better or more granular way? I know I'm asking you in the most generic way possible.
No, but I think I understand your question. Yeah. I think I'll give you there are two versions of this answer, right?
Yeah.
And we did this at Capital One. We've tried this here. Social media data does not add value on top of the models that we build. It does not add any value on top of the models we're already building. There is an identity play to it sometimes, right? And so you're sort of able to ascertain fraud risk can potentially go down, but if your fraud controls are very strong already, social media data, and I think this is sort of something that I think most people have realized, right? I think in 2015, you must have seen a lot of articles about people using social media. 2019, there's nothing.
It has kind of
tapered off, yeah.
People have realized that, right? People have realized that the fact that for 380 million people, you have this goldmine of data that you're actually able to make decisions on. And I'm talking about everything across, right? The information that the person gives us, the bank statement information and bureaus.
Yeah.
It's such a goldmine of data that you're able to actually make decisions on. It's very hard, no matter how hard you try, it's very hard to find extra incremental variables on top.
Right.
That, and the other important aspect of it is that do not mess with the user experience.
Right.
Because the biggest problem in lending is that the more hooks you add to the lending, to the application process, the higher the risk.
Okay.
Because the only person who's willing to go through many number of hoops is a person who's not able to get credit from anywhere else. Right?
Interesting.
And so you obviously have to manage that aspect as well. You have to actually keep it to a minimum, right? Which is, I guess, that's the industry standard.
Right.
When someone applies for a loan and someone asks them for a bank statement, he's expecting to give a bank statement, right? If you ask for something out of the ordinary, I don't know, the three of us would drop out right there, right? Most likely.
Yeah, but
right?
Is this process to an extent standardized, you think? I mean, is there like a checklist of, which is kind of, if I go to any bank, if I go to any NBFC, like that is pretty much kind of standard requirement.
In terms of the information asked from the customer, I think
and
it's
also
pretty
in terms
standardized.
of the process, in terms of also the like
Process
steps
is not standardized at all. Process is not. I think that's where the biggest struggle for most people is. I think the process is not standardized at all. See, the challenge is that the demand is so high that no one is actually optimizing on the process. If you're a bank that is lending,
you'll
the
find
last thing that you're worried about is optimizing.
Yeah.
There are enough and more people looking to get a loan from you every day. You have to figure out at your pricing structure, you have to figure out which is the best customer and how you can find that customer and filter the rest out, right? And so the best and the easiest way for most banks to operate is to have the lowest pricing, right?
Yeah.
Then you have to put in zero effort in anything, because automatically all the good guys self-select to your product. They come in, you're able to look at all of their data. You don't even do much there. You just let them go through and you build a book very, very fast.
Yeah.
I think there is not a single large NBFC player that I think I've seen is worrying about the process as much they're worrying about, let's say, the risk of it, or maybe even the cost of origination of it.
Mm-hmm.
Right? I think everyone's trying to drive those metrics down. Everything else, they have enough and more people there.
That's pretty interesting. So in terms of India lens, again, you can answer this at your will, but two questions, like competitors who are doing good work in the space, and B, like what do you think the next step is sort of in terms of the evolution of the company? I mean, obviously more the merrier in terms of volume, higher the volume, better it is, but in terms of any other low-hanging fruits or any other synergistic things that you see out there which can be targeted in the Indian ecosystem?
Right. So two questions, right?
Yeah.
I think first you would have to qualify the word good work,
Yeah.
right? Because that, I think, so there are a lot of people doing lots of interesting things.
Yeah.
Some of them are scaling up rapidly.
Yeah.
I am, given my personal experience, about 6 years having actually worked through the recession, I am not of the opinion of scaling up rapidly at the expense of not understanding risk, right? If you scale up rapidly, you also understand risk at the same time.
Right.
Has to be a major focus area.
Yeah.
Because this market is going to turn.
Yeah.
It might be a year, it might be 2 years, it might be 5 years, but the market is going to turn. And people with not such great practices are going to struggle in this market, that is for sure. So I think if you were to look at it, there are a lot of people doing very interesting things, solving real consumer problems even, right? But very few of them I have seen focus on the risk aspect of it. And the ones that are, I think, are going to be clear winners, right? And there are enough, I think, that have sort of opened up certain spaces, like a couple maybe in the self-employed segment, and have opened up segments that other people were not servicing,
Right.
actually very good segments,
Right.
right? I think because they solved the problem by looking at segments and understanding these are people not served for a different reason outside of risk, right? And they went and attacked that, and they're probably the ones doing well, and they will continue to do well, right? Because their fundamentals are quite strong. The other ones, and I'm sure you've read stories about a few of them in the papers recently, but I think the practices have to be kept in check for most of these guys. I think that risk has to be primary. Scaling up at the cost of, not worrying about risk, I think is a very risky strategy. Given our experience, when we were Capital One, right? And Capital One was not Capital One been around about 20 years, maybe not even that when I first joined, maybe about 15 years in existence, and saw a lot, right? So the recession, and at the time of recession, all the banks had actually pulled back on the lending, and all of these new players came in, and they went into the spaces that we weren't comfortable going into, right?
Sure.
Very rapidly, you saw all of those players just go away, rapidly disappear, and it happens, right, at a time of cycle. Your fundamentals are not right, and we would sit outside the system and we would look at these guys come in, and sometimes it looks like very exciting territory, right? Because the interest rates, the margins on some of those products are crazy high, and in the beginning there's no risk, right? The risk on some of these cases manifests so late,
right,
that you don't get enough time to actually mitigate it.
Yeah.
I think that's one of the things that I think is probably something that people need to be mindful of. I think there is enough good work happening even at some of the NBFCs, if you were to ask me. Large NBFCs that are working today, maybe some of the large banks as well. I mean, the ones that we work with, every day there are a few of them that I'm impressed with in terms of their understanding of tech, the fact that they understand the customer so well. Right? Some of them understand the customer so well, I think it shocks us, right? Because we are the ones that are interfacing with the customer, we are asking the questions, right? For the startup, we're doing all of the cool product things, and then these guys come along and they come in with such deep understanding of their customer. It actually impresses us. I think there are a lot of banks and NBFCs doing really good work, especially on the consumer side that we are seeing. There are a few startups, like I said, right, that are very interesting.
When you said, like, you use the word innovative, you said that, okay, it's difficult to qualify what is good, but there are definitely a lot of companies who are doing innovative work. You gave like one example, I guess, like in terms of self-employed.
Yes.
What do you think are, can you give us some other cases where you think those are innovative segments to look at? I mean, leave aside how good their models are, or how robust they are, but just in terms of, like this is like, for instance, like I think a few days back I was reading about this company, Drip Capital, right?
Yeah.
Like they look at trade financing, right? You must be
Correct.
Yeah. So I found it to be very interesting. I mean, obviously don't know how good their book is, obviously, but in terms of optics, it looked pretty interesting.
So there are, I think, lots of people when we're talking self-employed, right, in the SME segment, not even self-employed. I mean, like the SME segment, there are lots of opportunity that people have found. Most of those, and I'd probably say, I think not most of those, but I'd say more than 50% of that opportunity exists because of the banking sector and NBFC sector not lending as much right now.
Right. Okay.
There is, when you're talking about SME segment and the segment, so we looked at it, right? We looked at the SME segment briefly, and we very rapidly realized that the segment that we were mostly interested in were all served, and at rates that a typical NBFC wouldn't be able to compete at, right? And so when we looked at, let's say, a typical SME, maybe a turnover of above something, filing GSTs and whatnot, a lot of these guys were served. Now when we're talking about the people, think there is a large, and which is the biggest segment, right? And I call it a self-employed segment.
Okay.
This goes from people's requirements are maybe, let's say, between 1 to 10 lakh rupees, right? Not north of that. That segment continues to be underserved, and it's a very difficult segment to underwrite.
This is the Mudra loan segment.
You could call it the Mudra loan segment. You could call it the 2-minute MSME loan, if you've heard of that segment. It's a very difficult segment to underwrite because the data about this is very hard to get.
This is outside the 380 million.
This is outside 380 million is people bureau, right?
Yeah.
So consumer bureau.
Yeah.
So you borrow personally.
Yeah.
When you borrow in the name of the business, there's business bureau.
So is this typically working capital financing? Is that a big chunk of it?
It's mixed up. It's muddled up. This type of financing is muddled up. This person might or might not have a current account.
Yeah.
So they're not in the
might
formal
or
sector.
might not. Yeah, they're not in the formal. Huge sector. Huge sector. But very difficult because this guy has 5 bank accounts.
Right.
Mostly 3, 4, 5. Most likely you end up figuring out or finding out only about one. You don't see the other transactions. You have to second guess and try and go in deep. Right? So some of them have actually got like models where person goes to the shop and asks a lot of questions. There's an interview. It works, but it's not as scalable.
Right.
Yeah.
It's a great model. It works, right? And it does work. And I know a couple of NBFCs that do an amazing job of this.
Right.
They go deep. They try and understand. They're able
It's very
to underwrite.
intensive, obviously.
It is super intensive, and to be able to find such people, very hard. And so that's where the challenge is, right? You're trying to build a really scalable model, and being able to build it in that particular segment is super hard. And so a lot of people have taken a lot of view. See, again, I think our view, right, is that if something has to be as scalable as, let's say, a Capital One model, it has to be data-led.
Yeah.
Right? It has to be data-led. And unfortunately, the biggest reason we haven't ventured so much into that segment, we're slowly getting there, is just the lack of data in that segment. Very hard to get the right data and the format, right? So now with GST data coming in, I think that space starts to open up for everyone. Right, so that's a space.
Sorry, I plead ignorance. When you say GST data coming in, what exactly do you mean?
Obviously there is people have access to if someone is filing GST or not. Like the person can give access to that data.
Okay.
To try and understand.
With consent. Okay.
With consent. Yes.
Okay. Oh, interesting.
And so with that data coming in, I think there's lots of interesting. But this is again that segment, right? That is filing GST.
Yeah.
Still not getting there.
It's
still not getting there. But it's something.
Would you guys ever get into direct underwriting?
It's a thing that it's an idea we toy with almost
Sure,
every other
I'm
week,
sure you
right?
do.
In all board meetings, right?
And there is no
And
easy answer. I completely understand that as well.
it's not
And-
an easy answer. See, again, I think our thesis is the if you look at the problem, right? Actually, we going back to the problem. The customer that is coming to us is cuts across is
Yeah.
sometimes very very high quality, right? And so this person requires the best loan or best interest rates possible. For us to set up our own NBFC and offer rates competitive with, let's say, the largest banks in the country is next to impossible, right? Doesn't mean that I stop serving this customer. Why should I stop serving this customer?
Sure.
And so therefore, the
Conflict.
marketplace element of it never goes away, in our opinion. The only long-term evolution here is that there might be certain interesting segments. There might be. And we haven't seen anything where we're not able to go to an NBFC or a bank and tell them, there is an interesting segment where we think people are credit worthy. Are you interested in opening up that segment? We haven't come across a segment where people go back and say, no, I'm not interested. Now you go and set up your own maybe, or you do it yourself. We don't do it, right? We haven't come across that. I think there is enough supply in the market, and that's the thing that we continue to actually build this business on. There is enough supply. I think the fact that the supply thinks that we have the right to people to work with actually has worked in our favor a lot.
Yeah.
Because now we've close to 50 partners working with us, opening up all sorts of different segments.
Yeah.
And we provide the end-to-end, right? We're the agent in this. So we're like the technology partner, we're the fulfillment partner, we're the sourcing partner, we're the analytics partner. We do the works for them and help them onboarding a customer end-to-end.
Does anything worry you about the space, about the business in general? Like, what keeps you up at night?
I think this business is very different from an e-commerce business because it gets affected by a lot of things, right? So our business goes up and then has a dip, and it goes up and then has a dip, and it goes up and has a dip, because then sometimes there's an NBFC liquidity crisis, sometimes there's Aadhaar judgment, and so people sort of go away from doing a particular thing. There's a lot.
Yeah.
And I think when we're talking about risk and cycles, I think there are mini cycles for institutions, and then there are large cycles for an entire country, right? Credit cycles. So institutions keep going through cycles, right? And therefore our business sort of gets impacted because of that temporarily. I think the biggest thing that we worry about today is that how do we get enough and more of such partners on board that we don't go through their mini cycles,
Right.
but going through the mega cycle is inevitable. Right? Everyone will go through that mega cycle at some point. 1, 2, 5 years from now, nobody knows, but everyone will go through that, and so we have to prepare ourselves for that.
Yeah.
Right. And I think there's going to be a dip in sales for us, a dip in revenues for us, but I think we prepare ourselves for that.
Let's talk a bit about. Not bad. We have already done 51 minutes. Quality conversation. Time just flies, doesn't it? Funding in terms of fintech obviously still is, but it used to be a very hot space. That it used to kind of fall off everyone's mouth whenever it comes to VC funding. Do you see that perception also kind of being a hostage to the cyclical trends?
I think there are a few aspects to this, right? I think most of the VC funding, as I've noticed, follows this exit cycle. When a particular space sees exits, VC funding starts to go up. In this, the segment is not mature enough yet for us to have seen any large exits, right? This is, if you talk about the payment space, if you talk about a large e-commerce space, I think you've seen exits there.
Sure.
I think there is that cycle, that element of it that's still not there, that no one has seen an exit yet. But I think there is that time. I mean, maybe another year, 2 years, I think people are going to start seeing exits. Then the activity sort of goes back up, right? It reinforces the VC's belief in the space. I think because we've been 5 years, a lot of people have solved lots of interesting problems. Lots of people have scaled up. So there is a lot of value being created in the system, but it's still not at a place where you can actually call it that, this is set, right? And I think that's what people's mindset beliefs are. I think there are obviously the fact that there are so many ups and downs with lots of things, right? Obviously affects this, right? Because then it slows down the exit timing, and so then automatically feeds back into people thinking that, maybe we're not ready to invest that much money in this yet. But you never know. I mean, there's one big event that happens 5 days from now, and then the frenzy starts back again, right?
Yeah.
Right. So that I think is where the segment is. This being related to the NBFC crisis, I think the NBFC crisis is not impacted as much on the funding, although the fintech startups that are NBFC led,
Right.
I'm sure have their own challenges, right? It's not easy in this market right now. It's not easy at all. And so they need to figure this out and they need to weather the storm.
Yeah.
But I think most of them are in a good spot.
Nice. So yeah, what's going on outside work? Watching the World Cup?
Yes.
And
It's been interesting. I think I'm worried about India. You know, when they did they did the same thing last World Cup, and then they went to the semis and then they lost the semis. I want them to lose.
Come on,
one.
you're so optimistic about everything else. So
Yes.
you need to be more optimistic about this as well. No?
That's
Fundamentally, they're okay.
Fundamentally, I think okay.
Yes.
Maybe that's where he doubts it.
I'm slightly worried about India though, right? I mean, I think because I passionately love the team so much, right? That you always worry about it. Every match or so, the Afghanistan game was like a crazy match. I watched till the end. I was like, if we lose to Afghanistan, actually it would have been a repeat of the 2011 World Cup, right?
Yeah.
We did lose to Afghanistan in that World Cup as well, I think, and went on to win it. Maybe that was the
An automatic check
Yes.
to kind of make sure that you are
that
driven
you
till
are-
the end.
Yes.
Well,
Wake
no,
up call.
No, on that note, thank you so much, Mayank.
Thank you.
It was great fun having you here, and I hope you also enjoyed as much as we did.
For sure.
Yeah, no, thanks so much for your time.
Thanks a lot for having me here,
I'm gonna-
guys. And best of luck for the future podcasts
Oh, no,
and
thank
everything
you.
else.
Thank you so much.
Thank you.
And yeah, so on that note, I think we can call it off. Just a friendly reminder to all the listeners, which I think forgot
Yeah.
in the beginning. Do subscribe to our channel by the name of Long Shots on iTunes, Spotify, Deezer, and many other. I'm not going to say eclectic apps. I usually say that any other apps that you like and you prefer. So do subscribe so that you get that nice notification every time an episode goes live. And yeah, with that, this is Nikhil Arora
And this is Sharat Tupran.
signing off.